In the 3 months to the 30th of September, Australia recorded headline economic growth of minus 0.5%. It was the worst quarterly growth rate since the December 2008 quarter, when the global economy was in the midst of an epic credit bust. Annual growth fell from a robust 3.3% last quarter to just 1.8% in the 12 months to the 30th of September. So, what's going on? Does this mean Australia is about to finally slip into recession after nearly 26 years of uninterrupted growth? That is a distinct possibility. There are virtually no growth drivers for the Aussie economy right now. Household spending is the only thing preventing the economy from falling into a deep hole. Even so, household consumption growth for the quarter came in at just 0.4%, the lowest rate of quarterly growth in nearly 2.5 years. With official interest rates already at historic lows of 1.5%, and with the RBA on the sidelines for now, it's not clear how households will increase future spending and continue to prop up the economy. Maybe through increased employment and wage gains, you might think. Well, don't hold your breath. Employment growth generally comes from investment spending. But investment spending is going backwards right now, the result of continuing falls in resource sector spending and a drop-off in housing construction. Now, admittedly, a big decline in government investment spending didn't help growth in the September quarter. But this simply partially unwound an even bigger contribution from the previous quarter. Adjusting for the erratic government investment figures, the rest of the economy has actually contracted by 0.2% over the past 2 quarters. So yes, the economy is sailing very close to its first official recession in nearly 26 years. And by that, I mean we're getting close to 2 consecutive quarters of negative economic growth. Now, this shouldn't be that big a deal. Recessions are an inevitable result of economic progress. But for politicians and central bankers it is. No one wants a recession on their watch. As I explain in my free report, vigorous efforts to avoid an official recession over the past few decades has created enormous risks for the Aussie economy. But it's not all bad news. The September quarter data had some bright spots too. Let me explain. The economic growth numbers you see published in the media every quarter measure Australia's economic output. That is, it measures how much stuff Australia produces. But it doesn't measure, for example, the change in prices we receive for our exports, and it ignores the change in prices we pay for imports. These price changes can have a material effect on Australia's economic well-being. Think of the large fluctuations in the iron ore price over the past decade. Iron ore is our largest export, and rising prices boost national incomes while falling prices drag national incomes down. There is a measure of economic growth that adjusts for these price changes. The Australian Bureau of Statistics calls it real net national disposable income. Now that's a bit of a mouthful, so I'll just call it underlying economic growth. But the important thing to keep in mind is that it is a much broader and I think better measure of economic growth than the headline measure that you see quoted in the mainstream media. This broader underlying measure indicated that economic growth for the September quarter was 0.8% and a healthy 3.2% over the past 12 months. The difference between the quarterly headline rate of minus 0.5% and the underlying rate of 0.8% growth is significant, and it reflects the big rise in commodity prices over the quarter, especially the iron ore price. So, what do these conflicting signals mean? Well, it simply tells you that the domestic economy is very weak and that all the growth is coming via rising export prices. In other words, only a small portion of the economy is firing right now, and that is largely thanks to iron ore prices. But there is no guarantee that iron ore prices will stay at their current high levels, which is over $80 a tonne right now. Much depends on China and their attempts to manage their economic slowdown, and no one really knows how that will play out, although I have long been sceptical of China's growth policy. The upshot of all this is that Australia has a growth problem. The boost from higher iron ore prices is timely, but it's not enough to mask a weak domestic economy. The RBA's massive interest rate cutting campaign, which got underway in late 2011, has produced a house price and building boom, but now both are running out of steam. That's not to say a collapse is inevitable, but it does beg the question of where the growth will come from in 2017. Consumer spending is the weakest it's been in 2.5 years despite low interest rates and booming house prices along the heavily populated East Coast. Falling investment spending doesn't give much hope for decent employment gains, so we're back to relying on monetary and fiscal policy for growth. Given the RBA is reluctant to provide another dose of debt-fueled growth via interest rate cuts, expect the government to turn to fiscal stimulus and increase infrastructure spending to prop up growth in 2017. This will, of course, blow out their budget and threaten Australia's AAA credit rating, which will bring about another set of problems for the economy. In short, there are no good options for Australia right now. We've run out of easy growth measures. This is the culmination of years of poor governance and an over-reliance on monetary policy and debt growth to provide a short-term boost to the economy. This policy now looks like it's hitting a wall. Australia is not quite in recession yet, but it looks like it's coming in 2017. And if China slows again and iron ore prices fall, we could well be in a recession on both the headline and underlying numbers. So what can you do right now to protect your wealth from this risk? Well, today, I'd like to send you a free report that provides further detail on why I think Australia is about to fall into its first recession in a quarter of a century. But first, a bit about me. My name is Greg Canavan, editor of the Daily Reckoning Australia. This is a free daily e-letter that looks beyond the mainstream headlines to tell you what really moves the market. More importantly, my team of analysts and I show you opportunities and risks that you won't read about in the mainstream business pages. In fact, we often ridicule the financial press for its conformist nature and lack of genuine insight into important financial issues. The report that I want to send you today reveals a 4-step plan that you can use right now to protect your portfolio from any recessionary fallout. If you manage your own money or want to keep up to date with urgent economic problems threatening your wealth, I invite you to download your free copy right now. In this report, I'll show you 6 sets of data that indicate Australia is headed towards recession, how years of over-reliance on monetary policy has created a fragile economy at the risk of a deep downturn, and why the government will have to increase deficit spending in the years ahead, which will bring its own set of problems. I'll show you all this and more when you download this report today. Simply click here and follow the instructions to download your free report. With your free report, you'll also receive a free subscription to the Daily Reckoning. As I mentioned earlier, this is a free daily e-letter written by me and my colleague Verge. If you're worried about an Aussie recession, you'll love Vern's work. He's a no-nonsense analyst who's seen it all before, and he thinks Australia's in for a big bust. So sign up now to get your free report. Thanks for watching.